of assets. So let's start with the categorization of assets and liabilities. Okay, we say that assets are economic resources or resources controlled by an entity from which future economic benefits are expected to flow to the entity. The meaning is that if you are saying that the plant or the machinery is your own, what shows that it's your own? Can you direct how people should use that particular asset? Do you have any right to any economic benefit that will be coming from the asset? The control has to do with, okay, if I'm using the asset, you can tell me that, oh, the quantity that you are going to be delivering with the asset should be all big. If you have a motorbike and if the motorbike is for your own, you can tell me the number of people that I can take on the motorbike. That is what we mean by the control. So the entity should be able to direct how the asset should be used. That's what we call the control. Okay. So we are saying that it should be resulting from past event. Past event means what? It should be something that happened in the past. It doesn't mean that if you bought the asset at the beginning of the year, at the end of the year, it is no. You can see that at the beginning of the year and at the end of the year are two different dates. So if you are talking about past tense, we'll be using bought for the January than the present tense. So that is an asset, but basically, if you want to talk about it, we say that assets are resources owned by what? By an entity. But the conceptual framework, which you will be looking at if you come to corporate reporting, define the asset in a different way. Okay. So assets are resources controlled by an entity. That is it. The resources controlled by an entity can be on various forms. Okay. If you talk about this thing is your own, okay, it can be something that we can see. It can be something that we can see. It can also be something that we can't see. So if you have a car, okay, the car is your own, so we can see the car. What if you have a copyright? What if you publish a book and you have what? Copyrighted the book. Can we see the copyright? No. It's not something that we can see, but we can hear that, okay, you have a copyright. Anybody that will go and do a photocopy and do a replica of that particular book without your intention, you have the legal right to what? To take the person on. But we can't see the copyright like how we can see the motorbike. So assets will come in so many forms. Assets will come in so many forms. You can have a motorbike that will be there for you for more than 5 years. You can still have a motorbike that you can sell within a year. They are all assets, but their duration is different. So we have so many categorizations of assets. So we are going to be looking at them one by one. Okay. So if you talk about assets, the assets, we have the non-current assets and current assets. If you talk about a non-current assets, we are talking about those assets that will be used in the company for at least 5 years or for more than a year. Okay, the assets that are not bought for their own purpose to help, but to help in running the business. They are not bought for their own purpose, but they are there to help the company run effectively and also efficiently. They are there for what? A smooth running of the company operations. Okay, they are not bought with the intention of what? Resell. They are going to be in the company for a period of time. That is what we call a non-current asset. So if you purchase a motorbike or if a company purchases a motorbike and the intention is that they are going to be using the motorbike for administrative purposes, the motorbike is what we call a non-current asset. But if the entity purchases the motorbike and they are expecting to sell the motorbike within a year, we are saying that that is what we call the current assets. So asset that will last for more than a year, technically they can be called the non-current asset, or asset that are not bought for resale, but to help the company run its operations. Those are what we call the non-current assets. So the computer that is in your office is a non-current asset. It's a non-current asset. So, but the current asset are those assets that can be sold or realized or consumed within the normal operating cycle. So within a year, the asset can be converted into cash within a year, within the shortest period of time. Okay, Let's come to non-current assets. The non-current assets, the assets that will be in the company for some number of years. Some of them we can see them, like the plants, like the building, like the land. Some of them we can see them. But something like trademark, we cannot feel it, we cannot touch them, but we can just, okay, this particular company is having a copyright, is having a patent right, but we cannot see what actually is the patent right. It's only the certificate that we can see. The certificate is not the patent right. Okay, the certificate is not the patent right. It's just a confirmation of the rights. But can we see what they are calling the patent right or the copyright? No. So the non-current asset can be a tangible non-current asset or intangible non-current asset. The tangible assets are those that have a physical existence. They have a physical existence. We can see them, we can touch them, and we can also feel them. Example would be the building, the computer, and those ones. But for the intangibles ones are those that we cannot see, but they are resources owned by the company, but we cannot see them. Example would be the trademark, copyright, and other forms of non-current assets that are intangible. Okay, if you come to the current assets, we are saying that they are those assets that can be realized within 12 months period. They are those that can be converted into cash. Those are what we call the current assets. So what are the examples of the current assets? Examples of current assets.
Okay, so inventory.
Okay, inventory. Okay.
Cash.
Yeah.
Okay, cash. Okay.
Trade receivables.
Trade receivables. Okay. Okay. We can also have.
Okay, that's
Okay, we can also have prepayment.
Expenses prepaid.
Okay, so we can also have prepayment and also owings. Okay. Okay. So anything that can be converted into cash within a possible or within a 12-month period, and it's owned by the company is what we call the current asset. If you look at the inventory are those items that are bought with the intention of resale. Okay, so if a company is selling machines, whenever the company purchases machines, the machine is an inventory, it's a current asset because the machine will be converted into cash within what? A 12-month period. The machines were bought with the intention of resale. So inventory are those items, are those assets that are bought with the intention of resale. So if a company is selling motorbike, whenever they purchase a motorbike, the motorbike will not be classified as non-current assets. No, because that is their inventory. So that will be classified as current assets. But if the company is selling motorbike and they purchase computer is not part of their day-to-day operations. So the computer will be treated as a non-current assets. Receivables are those that the company sell goods to on credit. Those that are owing the company, those are the people that we call the receivables or the trade receivables. Okay, let me differentiate between what we call receivables and trade receivables. Okay, you see the word is trade receivables. Trade means what the company is trading in their normal activities. So whenever the company sells stock to their customer on credit, that particular customer becomes what we call trade receivables or trade debtors. But whenever the company sells any other thing apart from stock, like fixed assets, to someone on credit, that particular person becomes what we call the receivable or the debtor. So the trade means that you are selling stock, you are selling your inventory to someone on credit. You are selling your inventory to someone on credit. Therefore, that person is a trade receivable. But if you sell assets or any other thing apart from the inventory to someone on credit, that particular person will be classified as what? As part of receivables, not trade receivables. Okay. If you come to cash is the most liquid asset. So if you have cash, you can spend the cash at any time. So cash can be within a minute you can spend the cash. So cash is also a current asset. Okay, the receivables are those who are owing the company. You can't give a credit period to someone who is owing you more than a year. No, if someone is owing you, you can give the person like 10 days or 30 days. You can't give more than a year. So you can be able to collect the money, or you can be able to convert that particular receivables into cash within what? Within a year. So that is what we call the current what? Assets. So all those things that can be easily converted into cash within a shortest period of time, usually within a financial year or 12-month period, those things are classified as what we call a current asset. But those items that is going to take more than a year or two or three or four, but they are not even bought with the intention of reselling them. They are not bought with the intention of what? Resell. They are going to be used to help the company administratively, or they are going to use to help the company produce its goods. Those items are called the non-current assets. All right. All right, let's go to liabilities. Okay. Liability, we say that. Seniors, any question about this one? Okay. We say that liabilities are what? Are financial obligations that a firm has to perform to other parties. Someone's resource in the company. That is what we call it. Okay. Sinaima? Sinaima, your hand is up. Please, your network. Sinaima, your network is very bad. Please, can you position yourself very well? Please, we can't hear you. Can you position yourself?
Hello. Okay now,
Yes,
hello.
yes, now. Yes, now, Sinaima.
Okay.
Okay, you can talk now. Oh, he's gone. Sinaima, okay.
Can you can, can you can you hear me?
Yes, I can hear you now.
Hello.
Yeah, I can hear you now.
All right. Yes, I was following some channels and they define assets as an economic resources used to generate revenue. As simple as this. Is it accepted based on the conceptual framework or something like that?
Okay, for financial accounting, conceptual framework is not part of your requirement. So you can also
Okay.
define assets as resources owned by the company or resources controlled by the company. Nobody's going to do anything. Are you okay?
Okay.
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 But the
I
asset,
think
if you come to asset itself, the asset should not only be something that will generate revenue. Okay,
okay.
it should not only be something that will generate revenue. If you look at the Kwame Nkrumah, we have some asset that we call heritage assets, something that is going to be there for historical purposes, like the Kwame Nkrumah museum or something like that. Okay, you can see that
Okay.
that particular asset over there is the asset for the state. You can see that we are not using that particular asset to generate revenue per se, although people might go there to pay.
It's true.
Okay, so
Okay.
uh,
Okay.
it's not about the asset generating revenue. Not all assets
Revenue.
might generate revenue. Are you okay? Okay, but
Okay.
in the business world, if you are going to get an asset, the asset might be something that is going to be generating economic benefit to the entity. Okay, so
Okay.
that is also not bad. All right. So let's
Thank you.
go to liabilities. Okay. Let's go to liabilities. liabilities. So the liabilities, we are saying that liabilities they are financial obligations that the entity has to perform to other parties. Okay. So if you have a company, you have your small company that you are managing, but the motorbike over there, the motorbike that you have over there is for someone, or you bought it from someone on credit. Okay, you can see that technically the motorbike belongs to the person. The motorbike belongs to the person. Okay, and since you bought the motorbike or you took the motorbike from the person on credit, you are going to be paying the person. So the amount that you are going to be paying the person is what we call the liability. It's a financial obligation. It's something that you have to do. It's a financial obligation on you. You have to pay it. So we see that the liability at the basic level, the financial accounting level, we can see that there are financial obligations that the firm has to perform to other parties or outsiders. Or we see that the outsiders claim against the business, or an outsiders claim on a particular item in the business. That is what we call the liabilities. Okay. Okay. So that is what we call the liabilities. But these particular liabilities, you see, some of them can be settled within a short period, and some of them can also be they're settled over a long period of time. Okay. Assuming you bought goods, or maybe you are selling shoes. So you bought the shoes from the person on credit. Okay. So you bought the goods or the shoes from the person on credit. You cannot be expecting this particular person to give you 2 years to pay the money. No. Because the person is also trading. The person will need the money to replace the stocks that the person has sold to you. So if the person should give you, it should be maybe 1 month. Okay, so you can see that this particular liability, which we call the trade payables, it will be settled within a shortest period of time. If you are owing electricity bills, you are owing ECG. ECG cannot give you 2 years to settle the electricity bill. No. The electricity bill has to be settled within a year. You can pay at any time. Okay, so we have liabilities that can be settled within a shortest period of time, and we also have liabilities that can be settled over a long period of time. Example, let's come to you go to the bank to take loan. You go to the bank to take loan. We're not talking about short-term loan. You can have short-term loan, but we are talking about a situation where you are taking a loan from a bank to finance your operations. The loan that you are going to be taking will be paid over a long period of time, say maybe 5 years or something like that. Okay, say 5 years or something like that. Okay, for that particular one, we can't say that particular liability is a current liability. No, because it cannot be settled within a year. So the liabilities that are settled within a year are called the current liabilities. Those that are not settled within a year, or they are settled over a long duration, maybe 2 or 5 years, 2 to 5 years, or maybe some of them you can really have them up to 10 years. Those are called non-current liabilities. The current liabilities, please, examples of current liabilities. I have given some of them in this one, but mention them again. Current liabilities. Examples.
Okay, payables.
Okay, payables. Okay.
Yes. We have expenses owings.
Okay, expenses owings. Okay.
Yes, we have bank overdrafts.
Okay. All right. So the creditors are the same as the payables. Okay.
Yes. We have debentures and loans.
Oh, no, those are debentures are normally take a longer period of time, so they'll be classified
Okay.
as non-current
Okay.
liabilities.
Okay. So short-term loans.
Okay, short-term loans is also fine. Yes, now Nicholas, one is up.
Can we say tax as example?
Okay, tax owings, because the tax will be settled within the next year. So tax expense is also a current liability. Thank you, Sina. Yes, now Michael. Now Michael, your hand is up.
Sorry, what of income prepaid?
Income,
Prepaid.
yes, income prepaid is also a current liability. So you are supposed to take a rent of 500 from someone, but the person has given you 800. It means that you are owing the person 300, and the rent might be on monthly basis. So the person will consume the rent in the following month or something. So income prepaid is also an example of current liabilities. Okay, let's come to the long term. Yeah, Auntie Annabelle.
I said, do we have anything like default payment? Is it deferred payment? Sorry, deferred payment. Sorry.
Okay, it can be deferred income, or okay, it can be a deferred income or deferred payment. It depends on how you are going to recognize it. Okay, let me give you the example. Okay, the example now is we have agreed that I'm going to be supplying you 20,000. So let me use this one. I've agreed that I'm going to be supplying you 20,000 units, okay, of goods within 10 months. Okay, within 10 months. But what happened is that we started the supply. The agreement was, we signed the agreement, or the contract was signed or agreed on in September. Okay, and my reporting period is December. So you can see that September to the end of the year, I cannot be able to supply all the 20,000. So I've supplied only some of them. But you have paid for all these items. You have paid for all these items. So let's assume that 1 unit is 10 cedis. So you have paid 200,000 to me. Okay. But I was able to supply, maybe this will be supplied monthly. It will be equal every month. So September, October, November, December, I was able to supply only 4 months. Okay. So I was able to give you only 4 months. It means that there's a remaining 8 months that I have to supply to you. Okay, so this particular 8 months that I'll be supplying to, I haven't supplied that 8 months to you yet. So I cannot recognize the amount as revenue. Indirectly, I'm saying that I'm owing you that 8 months because I'm here to supply those items. Although I will supply it and recognize the revenue, but I'm here to supply it. So the portion, which is the 8 months, is what we call the deferred income. Okay, deferred income, or if you want to call it deferred payment, there is no problem. Deferred income. Okay, so this one, it means that the person can come back and say, I don't need the 8 months again. I'm okay with the 4 months. So give me my 8 month money. So it's just like a liability because it is going to be settled or it's going to be consumed within what? Within a year. But situation where the contract is signed for 5 years and you supplied only 1 year, it means that remaining 4 years. So that 4 years, the deferred income can be treated as what? As a non-current liability. All right. Auntie Annabelle, I hope you are okay now with the deferred issue. Okay. That is about the deferred issue. Thank you very much. Let's count the non-current liabilities. Then we move on to qualitative characteristics. Then we pick some questions to have idea about how the questions are being set. Okay, what are the examples of the non-current liabilities?
Debentures, loans and debentures, long-term loans and debentures.
Okay. Long-term loans and what? And debentures. Okay. We can also have what we call lease liabilities. Okay, you'll be seeing something like lease liabilities where we have a finance lease. So we can have a lease liability whenever we have a finance lease. Okay. It's now Mike.
We also have deferred tax liabilities.
Okay, deferred tax liability that will also be shown as, but those are issues those are advanced issues. But the common issues that you'll be seeing will be maybe the debentures, the long-term loans, maybe sometimes at your level you're supposed not to be doing leases. Okay, so you can also see lease liability. As you are going, you'll be seeing more of what the non-current liabilities. And Annabelle.
Say,
Yes, please.
so what about bad debt?
Oh no, bad debt will be shown as an expense and that will be subtracted from receivable. So it's an expense. It's not a revenue. It's a revenue item, not a capital item.
So, but isn't it a liability?
No,
Like, can't it appear? Oh, okay.
no, please. No, please.
Okay.
What you have to know is that for balance sheet or statement of financial position, we only take capital items there. Capital items there. Okay. Capital items there. Okay. For profit or loss, we take what? Revenue items there. What do you mean by revenue items? Those transactions that happen on day-to-day basis, and they are going to be consumed. Their benefits will be consumed within a year, and they are recurring in nature, and they are always incurred for generating what? Revenue. Okay, so they can ask you the difference between capital expenditure and revenue expenditure. Okay, you should be able to say something. Capital expenditure are those expenses that cannot be consumed within a year. They are one-time what? Transactions. They'll happen once in a while. So if you acquire an asset, it will take some time before you can acquire the same type of asset again. It's something that will happen once in a while. It's not something that happens often. Okay, so what we do is that they are always capitalized and consumed over their useful life. That is why we have the issue of depreciation. We'll be looking at depreciation anyway. Okay, so capital expenditure are those ones that cannot be, their benefits cannot be consumed in a year, and they are not what? Current in nature. Current in nature, that means that they don't occur on daily basis. But if you talk about revenue expenditure, we are talking about those recurring expenditure, those expenses that are incurred to generate revenue, those expenses that occur on daily basis or monthly basis, or those expenses that are incurred in the day-to-day operations of the company. Example will be salaries, example will be discounts allowed, all those ones. So they can ask you the difference between the two. All right. So let's now move on to what we call the qualitative characteristics of what? Financial information. Okay. We are saying that the main purpose of financial accounting is to produce information for decision making. Okay, is to produce result or report that users will use for decision making. Okay, you cannot just produce any information and give it out like that. No, we want a reliable and relevant, or we want a good information that we can use to make the decision. You can't give us a statement or a financial information that has no supporting documents. You can't give us a financial information that cannot meet the requirement that we need it for. No. So we are saying that every financial information should possess certain attributes. Those attributes is what we call the characteristics, not something quantitative, not something that it should be represented by figure. No, but something that is non-financial, which is what we call the qualitative characteristics. So the qualitative characteristics are those attributes that financial information should attribute so that it will be useful to the users. Okay, so this evening there is a match between Barcelona and PSG. So we want to bet on that particular match. So we need the information. We need the information about this particular match. Now you are giving us a match between Barcelona and Man City. No, we cannot make a better prediction. So you can see that the reason that we need the information for, you are not giving us the accurate information. So the information given to us or the information that you are giving to us is irrelevant. It's not relevant to us because it cannot save the purpose that we want it for. Or the reason that we need the information for, that is not the, or we can't use that particular information to make the decision that we want to make. That is about the some of the characteristics. Okay, but the conceptual framework gives two categories or two categorization of these qualitative characteristics. One is fundamental qualitative characteristics and also enhancing qualitative what characteristics. What does the framework say about the fundamental? Okay, the framework is saying that the fundamental qualitative characteristics distinguishes useful financial reporting information from information that is not useful. So you are now giving us information. We say that we need information about Barcelona and PSG so that we know what will happen out of today's game. Now you are giving us information on Barcelona and Real Madrid. You can see that the information on Barcelona and Real Madrid is not relevant to us. It's not useful to us. But the one that will be on Barcelona and PSG is relevant and is useful because we are going to be predicting the match between Barcelona and PSG, and that is the information that we need. We need to have information about their previous what meetings. Okay, so that's what we mean by the fundamental. The enhancing ones are those that make the what the useful information more useful. They make the useful information more useful. What do you mean by they make the useful information more useful? If you want an information, the match is 7 p.m. So we need the information before that time. You are now giving us the information after 7:30. You can see that the information that you'll be giving to us will be what? Will not be relevant, will not be useful to us because it was not given on time. So we have some certain characteristics or certain attribute that is going to make a useful information more useful. It is going to enhance the usefulness of that particular information. That's why it is called what? Enhancing qualitative what? Characteristics. This one differentiates a more useful information from a less what? Useful what? Information. So the information can be useful, but if it is not given on time, it can also be an issue. The information can be useful, but if we cannot be able to say, okay, this information is being verified, or if we cannot be able to verify the information ourselves, or we cannot be able to ask someone to verify the information, then that particular information is going to be useful, but it will be more useful if someone can tell us that, okay, the information that the person is giving to us is accurate. Nothing is wrong about it. All right. So that is the enhancing qualitative what? Characteristics. So let's take them one by one. Okay. For the fundamental qualitative characteristics, we have only two. We have what we call the relevance, and we also have what we call the faithful what? Representation. Relevance and faithful what? Representation. Relevance and faithful representation. What do you mean by relevance? What do you mean by what? Relevance. Okay. You see right now, if we don't have any information, okay, if we don't have any information, we can just look at the weather and say that, okay, oh, it might rain today. But if we should get information from a weather forecaster or the forecasting department, they should give us information. Okay, that information can guide us to know whether it is going to rain today or it is not going to rain today. It will be with that particular information, we can be very accurate, or we can be close to 100% accuracy if you have the information than we don't have any information. So we are saying that an information or accounting information is relevant if it is going to make difference in the decision that the person is going to make. Right now, you completed, let's assume that you completed SHS or you completed university, but you haven't done accounting. Maybe you did what? Mathematics. Okay. But you don't know anything about what? ICA. So maybe someone told you something about ICA. So that is what you know. But if you should come to ICA, their website, to have access to their information, you think that the decision that you are going to make, whether to pursue the course or not, you visiting their website will enhance your decision than you hearing what they do and how they are from someone. Okay, so relevance means that the information should serve the purpose that it is needed for. That is the relevance. Okay, what did we or what do we make? What do we need the information for? We need the information to do this. The information that you are giving to us, is it accurate? Is it good for the decision that we want to make? We need information on plants. You are now giving us information on what? On motorbike. You see that the decision that you are going to be making, nothing is going to be out of it because we don't have accurate information. But we should have information on the plant. Yes, looking at the information, we can be able to make a decision that is going to be better and that is going to be okay. All right. So if they say relevance, relevance is a quality of financial information which is capable of making a difference in the decisions made by users. Relevant information has predictive and complementary value. So the information given to you should help you to be able to predict what happened in the past, what happened in the future, what will happen in the future, and what is happening today. You should be able to predict it. You should be able to do trend analysis from the information given to you. If you have the accurate data, you can say, okay, sales for this year is this one. Sales for last year was this one. Okay, this is the sales has increased by this. Okay, that is okay. Okay, so if the sales has increased by this, it means that, okay, the sales might be increasing by the same percentage or more than that particular percentage in the what? In the future. Okay, that is the information should have what we call a predictive value. We should be able to predict, make accurate predictions or close to accurate predictions from the information that we have. The next one is what we call the confirmatory value. The information should be able to help us confirm certain things, confirm things that happen in the past and things that happen in the present. Okay, so that is all about the relevance. They can ask you, you should be able to say something. Faithful representation, the word itself, faithful. Faithful representation, faithful. Faithful. Faithful representation. Faithful. Yes, Auntie Annabelle.
Say, are you asking what faithful representation is?
Yes, please.
Oh, okay, say, in our 3 words, I know that faithful representation means that an accounting information should be neutral, complete, and be free from error.
Okay, should be neutral means what? What do you mean by the accounting
It
information?
shouldn't be biased. It shouldn't favor one party and leave the other, or it shouldn't favor either of the parties. It should be neutral. It should be like it should be between and
Okay,
accurate.
okay, okay. So the neutral also has to do with as you as an accountant, you should not factor in your profession, your personal interest in the preparation of the financial statements. Okay, so interest and influence and those issues should not be factored in the what in the preparation of the financial statements. Let's come to it should be complete. Complete. What do you mean by it should be complete? What do you mean that it should be complete? Okay, complete means that the financial information should include all the necessary what? All the necessary things that the users need to know about a particular item. Okay, so if you are having plants in the balance sheet and the plant has been depreciated, you should give note on when the plant was purchased, how the plant is being depreciated, and the depreciation rates. Okay, you should include all the necessary information. You should not put certain information there and leave some of them out. No, give full descriptions and full explanations on the what on the items. Okay, that's what we mean by the complete. Okay, free from error. Free from error. We are not saying that the 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 financial information should be what? Error free. No, we are not saying that it should be error free. No, that's not what we are saying. But the error that will be there, we are not talking about 100% accuracy, no. But the error that will be there, the error that will be there should not be something that can affect the economic decisions that the users are going to be making. Okay. The error should be minimized. The error should be what? Should be minimized. Okay, you can't be preparing a financial statement and a sales of 20,000 Ghana cedis has been omitted from the book. No, 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 no. That sales that has been omitted can affect the decision that people are going to make it. So although there might be errors, but these errors should not be material. Being material means what? If we say something is material, it means that that particular item, if it is omitted, it is going to affect the economic decision that the people are going to be making. That's what we call the issue of what? An error being material. Okay, so we don't want that to happen. We also have certain, which is what we call substance over form, but it's not part of this one. Let's come to the enhancing qualitative characteristics. Enhancing qualitative characteristics. The first one is what we call the comparability. The comparability. Okay. The comparability, what we are saying is that we should be able to compare the information that you are giving to us to the performance of the company or to the previous information given to us, or we should be able to compare with what? A different company. Okay, so what it means is that if we give us 2021 information, we need to what? Compare that particular 2021 information to 2020 or 2019 to see why this figure is increasing, why this is happening, why this is also doing this. Okay, so you see that if you see financial statement of companies, you see that if they are preparing a financial statement, they prepare it in together with what? The previous year's what? Figures. Have you seen something like that before? That if they are preparing financial statements, they will add the previous year's own to the current year's own.
Yes, sir. Yes, sir.
Okay. Is because of the comparability issue. Okay. So they are doing it so that the users can be able to compare the company's performance over years. Okay. Comparability is being enhanced or is being achieved through what we call consistency. What do you mean by consistency? Consistency means that you should apply the same accounting policy for a certain period of time. If you want us to compare your revenue, okay, it means that how revenue is being recognized should be consistent. Okay, what we are saying over here is that the first year you are saying that you are going to be recognizing revenue as soon as you dispatch the goods to the people. So at the point of what? At the point of dispatching, that is when you are going to recognize revenue. The next year you are telling us that you are going to recognize revenue after the customer has accepted the delivery. So you can see that the first one that you are going to be recognizing revenue at the point of dispatch, you'll be having more revenue than if you are now recognizing revenue after delivery is accepted. You can see that you are using two means to recognize revenue. So we cannot be able to compare why this particular revenue is higher, why this particular revenue is low. Another issue is that, okay, you depreciated your assets. In the first year, you use what? Straight line method. In the second year, you are now coming to use reducing balance method for the same assets. No. We cannot be able to identify why the depreciation figure is increasing because we are using different accounting, different what methods of what you depreciating the assets. So consistency is very important if you want to do what? Comparison. All right, let's come to the next one, which we call the verifiability. What do you think verifiability entails? Verifiability. We should be able to verify the financial information given to us. How do we verify? If I've given information, how do you verify the information? If I give you information, how do you verify it? If I've given you information, or let's say I've given you figures on sales. Okay, I've given you figures on sales for 10 departments, and I've given you the total for the 10 departments. I have provided you the information that I used to what to get a 10 or to get a total for the 10. How do you verify the figure given to you? How do you verify it? All right, or at the workplace. At the workplace, some of you you are in a senior position at the workplace and you have people working under you. Okay, whenever those people bring report or something to you, do you just accept it like that, or you do something that we call checking? Do you check the figures or the items that they bring to you before you do whatever you want to do? Do you just accept it like that, or you do something? Yeah, now Mike.
I think you would have to cross check to see or to be aware whether everything is complete before you close it.
Okay, that's okay. That is if you have idea about what is given to you, isn't it?
Yes, please.
Okay, if you don't have idea about whatever the person is giving to you, how do you verify? How do you check? You can give it to an independent person who has an idea over there to check for you, isn't it?
Yes, it is.
Okay. So the issue of the verifiability is that, okay, the user should be able to verify the information given to them. How do we verify? We can take the financial information or the financial statement and try to what? Do the calculation ourselves. We can recalculate the figures. We can add the figure to see, okay, this is how you are saying that you have gotten the gross profit. How do we make sure that that is the figure? We can take a calculator and recalculate whatever they have done. Or we can also confirm or verify the figures. If it is depreciation, how is the depreciation done? We can also perform the same process to see whether we can get that particular what figure. That's also a way of what? Of verifying. Or we can also verify if you don't want to perform the methods or the processes that are being used to arrive at the figures, we can also verify it through an independent third party. That is why you see that financial statements are being audited and the auditor will sign. Okay, so the auditors are also telling people who does not have knowledge in accounting that, okay, this particular financial statement has been verified. So just imagine you want to invest in a company and the company has given you an account that is not audited. Are you going to trust them to go ahead with the decision? Are you going to trust the information given to you and you go ahead with the investment with them? You want to invest in a company and you are requesting for their financial statement and they have given you an audited report without the financial statement is not audited and there's no stamp of any audit firm and there's no signature of an auditor. will you go ahead and invest in the company?
No.
No. Okay. But if
No, sir.
if the account is audited, that is also telling you that this particular account has been verified by what? By a professional, by an independent person. So verifiability also has to do with two independent individuals reaching an agreement or a consensus that the financial statement has been prepared faithfully, or the financial statement is free from error, or something like that. That's also a way of what? The verifiability. So the auditing part of the accounts is also an issue of what? Verifiability. Okay, let's come to what we call the timeliness. What do you mean by timeliness? What do you mean by timeliness? Timeliness? What do you mean by timeliness? Timeliness.
Sir,
Yes, please.
the timeliness involves an accounting information being provided at a specific and required time or on time. So if an information has to be given, let's say an investor wants to invest into a company and he or she needs the company's audited, financial statement. Within a specific time, the company should be able to provide it at that specific time.
Okay. Thank you. That is cool. Yeah. Sniding.
Yeah, good evening. So with the timeliness, I also think that it's requires that the financial information should be provided at the needed time when it is needed, like a period in which it is needed, because as if it's given at any later date or any later period, it doesn't become relevant anymore. So timeliness also makes the information relevant.
All right. Thank you, Sina. Sina Edison, your hand was up first, or they have said what you want to say.
Yes.
Okay. So timeliness has to do with financial information should be given as at when it is needed. So if we want the information within 2 months, it should be given within the 2 months. It should not be given after 3 months. In that time, it's the reason that we need the financial information for, we cannot use it again. It will become useless to us. So timeliness has to do with the information should be made available to the decision makers as at when it is what it is needed. All right, that is timeliness, and that is why financial statement, the company will be asking them to prepare it on maybe monthly basis, semi-annually, or what at the end of every year. And that is the reason we have the financial statement being prepared at the end of every year. Let's come to the principle of understandability. What do you mean by understandability? What do you mean by the financial statement should be understandable? Yeah, Sines, what do you mean by financial statement should be understandable? Yeah, Sinema.
Yes, sir. Financial statement, I think they are always prepared for a purpose and for maybe the users of the financial statement. I think they should be presented in a way that the users of the financial statement will understand it. Will understand they should disclose maybe the method that they used and every explanation that they need to give for the users to understand and obtain the full benefits of it.
Okay, that's cool. Yes, Sina, Mike.
Okay, so in addition to what my brother said, it shouldn't be, it should be prevented from the use of a lot of jargons and then difficult phrasing in its annual report in attempt to disguise the underperformance.
Okay. 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 That's nice. Yes, Edison. Sina Edison, your hand is up.
Okay, so this is when a layman uh, takes the financial statement or the report, you'll be able to understand it so that he can make decisions on it. It shouldn't be something that it will be very difficult to understand. It should be in a plain language where everyone could understand the financial statement. Thank you.
All right, that is cool. That is cool. So that's you have all said it all. Understandability has to do with the financial statement should be prepared and presented in a manner that reasonable knowledge people, someone with the knowledge can able to understand whatever they are saying. So the format for the preparation is very important. Disclosures, footnote to whatever is in the statement is also important. Footnote to whatever is in the financial statement is also important. So whatever method that you have to use to get the figures must be disclosed. And how you arrive with the figures must also be what? Must also be disclosed. So you have to give disclosures, you have to attach footnotes, and the financial statement should be prepared in the language that everyone what understands. You are preparing a financial statement for people in Ghana and you are using Chinese to what to prepare the financial statement. No, that is even the reason that those outside companies, especially Chinese, the Japanese companies, their financial statements are being prepared in two different languages. One will be in English and one will be in their Japanese what language. All right. So for people, for anyone who is interested in the financial statement will be able to take it and understand it. Okay, let's come here. You see, you cannot have financial statement that is going to be having all these what characteristics because of certain reasons. You cannot have financial statements that is going to have all these characteristics. Why? Sometimes the time that the information will be needed, they will say that, okay, the financial information, we say the financial information should be provided as at when it is needed. So sometimes management, the accountant will not be ready, but the management will be telling the accountant that, okay, we need this particular information at the end of the day. So the person is not ready. So the person will now be what? Will now be in a rush to prepare the financial statements. So that kind of pressure can lead to what? Inaccuracy. The person will end up providing inaccurate and unreliable what? Information to the people. And if the information is inaccurate and unreliable, it means that the principle of faithful representation will not be there, or the characteristics of faithful representation will not be there. So all these characteristics cannot just be achieved like that. It will come, or it will also have situations that is going to limit the financial statement to have all these what characteristics. All right, those are what we call the cost constraints on the financial reporting. The time we say that the financial information should be given as at when it is needed. Okay, if the financial information or the financial statement is needed quickly, it might end up what in inaccurate and unreliable what information that people might, or the accountants will end up providing what we call inaccurate or unreliable financial statements. Okay. Another one is also what we call the cost benefit analysis. The cost benefit analysis. If you look at all these characteristics, okay, look at the volume of the operations of the company. If the company is an international company and they have to prepare a financial statement at the end of every year, it means that they need to get a lot of people to make sure that the work is what is done within that particular year. So they are going to be employing more people to make sure that they are able to get a financial statement ready at the end of the year. Another one is also has to do with the verifiability. Verifiability, we say that an independent person should also look at the financial statement and say that this is like this. But the financial statement is being prepared in all aspects required by the law. So we are going to be having issues of auditors. We are going to be paying the auditors. So the question now is, how much are we spending to make sure that the financial statement is what is relevant, it is useful, and it has everything that the users need. But the question now is, what benefit are we going to be getting from preparing a financial statement that is more useful to the users? What benefits? Okay, we are spending 10,000 Ghana cedis to get a financial statement to meet everything that the financial statement has to meet. But the investment that we are going to be getting is only 5,000. No, you cannot, that would be a bad investment. So you just look at it and say, oh, the money that I'm going to spend to get a financial statement, the cost is higher than the benefit that I'll be getting from it. So let's just leave it. So the cost benefit analysis can also, if the cost is higher than the benefit that the financial statement will be giving to them, they can decide to what? To ignore and what? And leave it what? Like that. So the two constraints are the cost and benefit, which we call the cost benefit analysis, and also what we call the timeliness, the time that the financial statement will be needed. It might lead to what provision of inaccurate and unreliable what information. Sina Emmanuel.
Yes. The benefits of financial statement, though we know there are a lot of uses, but can the benefit be quantified in monetary terms, as in, okay, so the benefit that we'll get might be more than the expenditure or the investment that we are making?
The benefit will be in terms of the investment that we'll be getting in the coming year because we are preparing the financial statement for this particular year, or we have spent 10,000 in getting the financial statement ready for last year, but the benefit or the investment that comes in was only 5,000. So it means that even if we get a financial statement ready, the benefit in terms of investment will not be higher than the cost that we incur. So they can base it on that and see they are not going to spend on the preparing the financial statements. I hope you're okay now.
Yes. So based on the previous year's assessment or something.
Yes, please. Or they can even use the previous years to estimate what will happen in the future or what will happen after the year if they should get a financial statement ready. All right.
Okay.
So that is all. Let's come to some tutorial questions. Then we start with what we call the books of original entry, day books. Okay, the day books, we try and see whether it's not anything. It's very simple. You see, I realized that if I'm using the notes, like we not be moving. Okay, but I'll give you notes. I'm on the notes on the day books. Okay, but we'll be doing more of the calculation. So if you are doing more of the calculation, one thing about counting is that if you know the calculation very well, you automatically know the theory too. Okay, so let's look at some tutorial questions over here. Then we see tutorial questions. 1, explain each of the following characteristics of useful accounting information. Please, you are the one who is going to write the exam, so you will be explaining the things over here. Okay. So the first one is the relevance. What do you mean by relevance? We just spoke about the issue of relevance. What do you mean by relevance? Yeah, Senior Mike.
Okay, to my understanding, relevance accounting information should be relevant to the needs of users, so that it can help them to evaluate the financial performance of the business, and then also draw conclusions from it.
What you are saying is comparison, okay? Okay.
Is
That,
that
yeah, you are talking about comparison, comparability.
really?
Yeah.
Okay.
All right, Sinema.
Yes, sir. So relevance, accounting information is relevant if it has a predictive and then confirmatory value.
Okay, so can you, this one, they can give you 2 marks. The mark, it will be for 10 marks. So the marks allocation will be like 2. So you can go ahead and say something. Okay, although you have said
Okay.
what the relevance means, you can go ahead and see if you can explain what you mean by the predictive or the confirmatory, or you can also talk about relevance in a different way. Okay, so the information given should have a predictive and a confirmatory value. This means that the information should be able to help people to predict what will happen in the current, what has happened in the past, and what will happen in the future. The confirmatory value is that people should be able to draw a conclusion that, okay, this is the reason why this thing has happened. They should be able to confirm something that happened in the past and something that is happening currently. Okay. Or relevance also should make sure that the decision that the people are going to be making with the information given, there should be, yeah, we have the slides already. So it should be able to make a difference. The information given should be able to make a difference in the decision that the people will be making if they don't have access to that particular information. Or relevance, and information is relevant if it is serving the purpose that it is needed for. All right. So you just have to explain it, or you just have to say it so that the 2 marks, they won't take anything from it again for you. All right. So whatever, all the things that you know about,
Write small block for one.
yeah, all the things that you know about relevant, say it, but don't waste time. Okay. Say it, but don't waste time. Let's come to what we call understandability. Okay, I hope the understandability we can all kill that one. Understandability. Yes, yes. Understandability. What do you mean by understandability? Yeah, Edison.
Okay, so understandability is a measure of how easily an individual can comprehend company's financial reports or accounting information.
Okay, okay, okay. That is nice. Okay, that is okay. Any, yes, scenario.
Okay, so understandability is the characteristics of accounting information whereby be able to be comprehended by the users. That's the people who the information is intended to be given to. That's the all material matters.
Okay, that is okay. Let's come to materiality. Okay, Auntie Annabelle. Materiality. Yeah.
Materiality. Yeah, this kind of concept actually determines how the misstatement of an information in a financial report can actually affect the user's decision making.
Okay, okay, okay. That is cool. That is okay. That is okay. Yes. Anyone? Materiality. Materiality. Yes, never.
Materiality has to, just as she said, that if they omit maybe a particular piece of information or a figure, how it could affect and influence the decisions of the users. And I understand that a particular something omitted in one financial statement might not be material, but same amounts or same omissions might be material to other firms or other financial statements.
Okay, so
That's what I can say.
materiality is industry specific. Okay, but if you are making judgment on issues of materiality, you should be looking at its effect when they are aggregated. So you can see one city now is not material, and not another two cities will go and happen somewhere. But if you put all these figures together, they can have effect. They can be material. So materiality has to do with the nature of what you are omitting, and also the size. Okay, so if the issue is a criminal issue and you are omitting it, the issue is a criminal issue, or the company is engaging in what? Child trafficking, and you are omitting that particular issue. You know how sensitive that information is and how that particular information can also impact the decision that what the users will be making. If we talk about the size, that is the nature. Let's talk about the size. The size has to do with the currency. If you are determining materiality, materiality should be determined on total level. What do you mean by total level? You will see one city from the sales. One city is not there, or one city is missing in the sales accounts. You see that there is an issue of two cities in the salary. Okay, you go to a different place, you also see that there's an issue there. But if you put all those figures together, you see that it will be a rich figure. So that will be a material. That will be material. So we say that information is material when its omission from the financial statement is going to affect the economic decisions that the users are going to be making. All right. So let's come to issue of completeness. The issue of completeness. Completeness. What do you mean by completeness? Yes, Sinamite. Completeness.
Okay, so this is whereby financial information or statements include the statements occurring during the accounting period should be stated so that it can cover all that of transaction that occurred during the stated accounting period. It shouldn't, they shouldn't, the user shouldn't, based on the accounting information should not be incomplete to the users. So that it will not, if it is incomplete, it becomes, the users becomes unable to make a sound judgment for the transactions.
Okay. Okay. Thank you. Yes, now Christian. Completeness.
So with the issue of the completeness, this means that the accounting information should be presented as it is. There are not supposed to be any omissions, removing some things from the information and presenting what he or she thinks is right. Like it should be presented completely. Everything should be presented. Okay, that's all. Thank you.
All right, thank you. Thank you. Okay. Auntie Annabelle, you want to say something about completeness? Yeah, Edison. Yeah, Edison. Your hand is up. Yeah, Edison. Edison. Your hand is up. Okay.